how does the government get its fingers into your pocket with regard to real estate? Well, there are two general categories that they deal with, and they're treated quite differently. You have operating income and operating losses, and you have gain on sale and loss on sale. They're treated very differently. Very importantly, the operating income from a real estate investment is considered passive income. So that all of your real estate or rental activity income is considered passive. So figure, okay, this goes into my passive bucket of income. Operating income, when you have income that's taxable on your return, is taxed at ordinary rates. Operating losses, your real estate operating losses, again, are passive losses. They're in this passive bucket that we're going to talk more about in a few minutes. And the important thing here at this point is to know that if you have real estate losses, they do not automatically go to offset your other income. We have several hoops to jump through first before we can determine how you're going to be able to use those losses. In general, how do we defer or avoid tax? On your real estate, we've got several things working for us that help us. One is depreciation. Essentially, when you buy an asset, I don't care if you buy a computer, or if you buy a house, or if you buy a stand, or you buy a table, you pay a certain amount of money for that, which is its basis. And it's over time, the tax law allows you to depreciate that asset, which means a fraction of that cost gets deducted each year until it's used up. We have passive income being offset by passive losses. Remember, we've got this passive bucket now. And your passive income and your passive losses are in the bucket. If you have passive income, it is offset by those passive losses. That can be a positive. That can be a positive impact here. You can qualify as a real estate professional. Again, forget what you think a real estate professional is. This is somewhat similar, but it's different. We're going to talk about what that means. If you can qualify as a real estate professional, the tax benefits that you have, you or your spouse, by the way, keep that in mind, either or. You can get some tremendous benefits out of that. And deferring or avoiding tax, don't sell your property, exchange it. Now, don't sell, exchange. If you've got real estate and you've got a profit in that real estate and you sell that piece of real estate, you're going to pay a big tax bill for the most part. There's a great section of the tax law, IRC section 1031, that allows you, as long as you're going to take that money and invest it in more real estate, it allows you to take that money with certain very specific rules that you have to follow. But if you follow those rules properly, you pick up that entire gain, you pay little or no tax on it, and you move the whole thing over to another property. We're operating now under what they call a modified accelerated cost recovery system. The reason it's such a long name is because it's gone through so many iterations, they had to come up with a lot of words. We have personal property, we have real property. Essentially, personal property is something like this that you can pick up and move. Real property is buildings, land. Land you do not depreciate, by the way. Land does not depreciate. For personal property, and that's essentially equipment and furniture for the most part, you're depreciating under the maker's system at an accelerated rate. What that means is when we take this piece of furniture is depreciated over 7 years. That piece of equipment is depreciated over 5 years. That's as much as you need to know about that. You can then depreciate it under makers, which is an accelerated method, which allows you to deduct more than 20% or 1/5 of that per year. As Fred pointed out earlier, if you have a business and you want even more deductions than that for your purchase of equipment and furniture in the business, you can make a special election to take it all in 1 year. Section 179 deduction. You can take it all at once. With regard to real estate does not have accelerated depreciation. Real estate is on a straight line method. That means after the first year, which is prorated by months, it's the same amount of depreciation every year, year after year after year after year, for 27 and a half years on residential real estate, and it's 39 on commercial. Your depreciation deduction adds to your passive loss, and your tax pro is going to put this on Schedule E on your tax return, and you have your income on the top, and all of your expenses for your mortgage interest and your insurance and your property management and your supplies and your utilities, and you get down to the bottom, there's a line for depreciation. An important concept about depreciation, every once in a while you'll hear somebody say, well, I'm not taking any depreciation because when I sell this property, I don't want to have to recapture. They've heard about recapture as if it's a bad thing, so I'm just not going to take any depreciation. It doesn't work. When you sell that property, you recapture depreciation, and the tax terminology is depreciation allowed or allowable. That means you recapture depreciation either that you've taken or that you could have taken but you decided not to. Talk about recapture for a moment. What happens is when a property is sold. When a property is sold, there are different tiers of determining what your tax rate is on that gain. How do we know what the gain is when we sell a piece of an asset that's been depreciated? And the answer to the question is, number one, we have to figure out if there's a gain. If there's no gain, we don't worry about it. If there's a gain and you've taken depreciation, then a part of the rate that you pay is going to be a function of what the depreciation was. If it's personal property, the recapture is at your ordinary tax rate, whatever that is. If it's real property, so it's been taken at straight line rates here, your recapture is going to be at the rate of 25%. It's just a formula. It's calculated. It's part of the deal. Passive. What is passive? What's a passive activity? What generates these passive losses? Well, the first part actually has something to do with passive. The first part of the law says that any activity or business activity that you have where you do not have material participation is a passive activity. That typically is a limited partnership interest. That's where you see most of this. You invest in a limited partnership, you give them their money, you don't have any say over anything, except on rare occasion, and it's very limited. You're not involved in the operations at all, and if you're lucky, you're going to make a lot of money on the deal. But that is a passive activity. Some S corporations are the same way. If you've got an S corporation where you have simply invested money and you're not actively involved in the management of that company, you can have passive income and passive losses also from an S corp. If it's your company, if you're actively involved in the business, if you're a 10% plus owner, don't worry about that. That's this line here. All rental activities are passive. They don't care if you're out there painting and getting tenants and working your fingers to the bone every day. It's passive. Does it make sense? No. Just what the law says. Okay. One exception to this is oil and gas. I'm not going to talk about oil and gas, but if somebody says, no, I've got an interest in oil and gas and it's not passive, they're not lying to you. Oil and gas has an exception.